Why remuneration reports? Well, here are 4 quotes from Buffett and Munger. The first one, show me the incentive and I'll show you the outcome. Self-interest is a powerful motivator, one we'd all recognize. You get what you incentivize. That's another one that Buffett said often. But this is the one I like the most. Incentives provide a window to future results. And that's the way I look at remuneration reports. To me, they're not easy to understand, but I hope at the end of this presentation that people will find them a lot easier to understand, because you'll hopefully understand a lot better what to look for. Because what I found in the beginning with reading remuneration reports is there's lots of pages, and you have to go through lots of pages to find the things you're actually really interested in finding. But certainly they provide a window to the future results of the business. And this last one's my statement: only by knowing what management is being motivated to achieve can you have confidence in what the business will deliver for your portfolio. And I've just put down there in the last couple of days, in updating my slides, a recent example of Altium and one of the tip companies, East Coast Traffic. And I'll just give you as an example. Here's 2 perfect examples of when you know what people are being motivated to achieve, you know what's going to happen. Altium has a REM report that gives the bonuses or long-term and short-term incentives, whatever you want to call them, but incentivizes its management based on revenue, maximizing revenue and number of people who are on the list of people that they have. They were aiming for 50,000 clients. Because they're aiming for a particular number like that, management are very focused on that. 70% of their pay comes from that. Only 30% of their pay comes from increasing profits. So with COVID, what did management do? They significantly reduced their prices in order to get more business. Didn't quite get to their 50,000, but got close to their 50,000. So there's an example where management have actually done something to reduce their prices and hence reduce their profits in order to be more likely to qualify for their bonus. Now, it's not necessarily all bad, because when you read what Altium is doing, it's pretty good, but it's a perfect example of you get what you incentivize. East Coast Traffic, on the other hand, Adrian Nisbet and I had a conversation about a week ago, and he proudly told me as the very, very, very first thing. Oh, in fact, sorry, before I go on to that, Altium didn't even mention in their announcement to the markets what their profits were. All they mentioned is, with great detail, what sales revenue was and how many of the 50,000 clients they got to. East Coast Traffic, the very, very first thing Adrian said to me on the telephone after the hellos and how yous, and how's COVID affecting your family, the very next thing he said is, by the way, our sales are down, but you'll be really pleased to hear, despite sales being down on last year, profits are dramatically up. Now, there's a perfect example of somebody being motivated by profits. Now, his REM structure, his incentives, are entirely based on profits. So the idea of this is how we can read remuneration reports as a powerful filter. So structure-wise, I'm going to start with some basic principles, then how to recognize what would be ideal, and then we're going to take a deeper look at some of the finer points about it. So first, the necessary basics. Now, before we delve into any complexities, I think it's important with anything that we do that we first decide what do we want to achieve. And then, obviously, I'm a lazy person by nature, the simplest path to achieve it. I'm not into great complexities. If there's a complex way of achieving something and a simple way of achieving it, I'm always into the simple way of achieving it. And people often find it rather strange. They say to me, and I'm not only talking about members, I'm talking about friends. They say, but Howard, with your maths background, why don't you work out a mathematical model of this? I say, what for? There's a simpler way to get to the answer. I could work out a mathematical model, but if that's the simplest way, yes, I'll do that. If that isn't it's not that I'm against mathematical models, but if there's a simpler way of achieving it, let's just get to the simplest way. So to start with, let's see what we want to achieve. Now, we've chosen in Teaminvest to look at, with REM reports, clarity, alignment, and quantum. Now, the good question is, why did we choose clarity, alignment, and quantum? I mean, why did we put it in that order? Why didn't we make it quantum, alignment, and clarity, or alignment, clarity, and quantum? Why did we specifically say clarity, alignment, and quantum? And there was great sense at the time when we discussed it in why we landed up with that order and not some other order. The order is designed to take the most important one for us as investors and then go in descending order. So let's just go through those. I'll get into detail how we can assess them in later slides. But clarity, if a REM report is unclear, that's like you being a half shareholder in a company with somebody else and it's not a listed company, and they report to you in a way in which you can't understand it. The question you want to ask yourself is it deliberate? Why should it be unclear? I mean, I'm sure these people can write English, and if they can't, they can get somebody to write it for them. The question is, can we trust this board and management to be stewards of our money? So if it fails clarity, and we don't know that we can trust board and management to be stewards of our money, we should put a cross next to it and say, it doesn't pass our filters. Now, when I say clarity, I'm talking about clarity to somebody who's read quite a few of them. If you're reading your very first remuneration report and it's clear, then you're either very smart or it's a very simple one, because the first few you read don't tend to be terribly clear. But if you've read half a dozen of them and you still think they're unclear, then big cross next to it, or this latest one's unclear, big cross next to it. We'll talk some more about that in a moment. Alignment. If it's not aligned with what drives wealth-winning returns, how can we expect wealth-winning returns? So alignment is absolutely key as well. If the things they're motivating people to do won't give us wealth-winning returns, it'd be fairly foolish of us to expect wealth-winning returns. And again, as I say, I'll go into all of these in more detail. Quantum, this is a two-edged sword, because it could be damaging to us if they take too much money. I mean, I wouldn't like it in my example before that Keith gave also, if the person took too much money for pay, but it may also be much worse for us if they lose their most valuable people. So quantum's a bit of a balancing act. If they're being paid too little, they'll leave, go elsewhere, and since people are the most valuable thing in every business, losing the key people would be more damaging for us than losing a customer contract or anything like that. But on the other hand, we don't want them taking too much. So what I'm going to cover in the next several slides, quite a few slides, is how we can look at all those three. Now, how do we assess them? Clarity, fairly simply, could you as an owner, assuming you've read a few REM reports before, understand what management is paid and what they've incentivized to achieve? And the second part of that is probably the more important one, and I'll explain that later on as well. It's what they're incentivized to achieve that's much more important than what they paid. If I was told by a company, our CEO is going to earn in total, call it $1 million for the year, see, keeping the numbers simple, and I didn't know how it was structured, and another company told me they were being paid $1 million and I didn't know how it was being structured, I have no way of telling which company is going to be more successful. On the other hand, if the one I'm told it's $1 million salary with no incentive, and the other one I'm told there's, say, $250,000 in basic pay and $750,000 in incentives if they achieve X, Y, and Z, and I like X, Y, and Z because it will drive wealth-winning returns, even though the $1 million may land up being exactly the same $1 million, my chances of a wealth winner are far better with the second one than the first. Alignment, could you see this motivating management to aim at wealth-winning returns for us? And we know what drives a wealth winner. We know the things we're looking for in a wealth winner, which we'll cover in another slide. And quantum, do you think quantum seems reasonable to retain valuable people without gouging us? So that's just clarifying a little bit. So now let's take each of those in detail. Firstly, clarity. couldn't understand what management's paid and what they're incentivized to achieve. Now, when you're reading a REM report, and we'll talk some more about reading them later, focus on what's incentivized, skip the boilerplate waffle. There's a huge amount of stuff in a remuneration report that is either ASIC required or ASX required, or your company secretary says, this is the way everybody does it, so you have to do it the same way, or the computer share or link or whoever it is that you've been using says, this is the usual stuff. So most companies land up with many, many pages in their REM report, most of which is cut and paste. There's really only a small part of it that matters, and that's what we want to focus on, and we'll talk about that some more. But clarity is subjective. Once you've read REM reports from about half a dozen companies, you should understand their clarity, or lack thereof, sufficiently to vote. It's then your call whether it meets clarity or not. But the clarity is, could I really understand what management is paid and what they're incentivized to achieve? It doesn't matter whether I like it or not. I may not like it. I may think it's a terrible REM report. It's paying people for all the wrong reasons, but it does pass clarity. The other hand, it could be a perfect REM report from a clarity point of view, short, sweet, simple, easy to understand, but terrible from a point of view of what it's paying the management. Then alignment. Now, alignment's objective, whereas clarity was subjective, alignment is objective. Why? Because we can actually put mathematical numbers on it. We're looking for three things to make a company a potential wealth winner: consistently high return on equity, achieved with little or no debt, and earnings per share marching steadily upwards over the past 5 years. And by steadily, we mean high stagger, and upwards, we just generally mean materially above inflation. So we can't put an exact number on that, but the other two we can put an exact number on. Now, since we want wealth winners, that's what we want in our portfolio, from an alignment point of view, clearly what we're looking for is companies that are trying to achieve these three things, or at least in this particular year, in the REM report, at least one of these three things. If they're trying to achieve high return on equity, we'd give it a tick. If they're trying to, high at least being above our 10%, if they're trying to achieve it with little or no debt, get their debt level down, we'd say, yep, that's good. And if they're trying to make their earnings per share march steadily upwards, we'd say, yep, that's good. Ideally, of course, we'd like all three, but you also want the incentives for management to be simple enough that they can aim for them. I always used to say that if you can't, if your person working for you is stopped at a traffic light that is red, and they can't work out in their head how close they are to achieving the incentives for the week, month, year, whatever it is the incentive is for, then it's too complex. So you wouldn't want to see a REM report that had targets for return on equity, targets for debt, and targets for earnings per share, but it would be nice to see that at least one of them is being heavily targeted, preferably 2, 3 is probably getting a bit much in the same year, but they could be targeting it in another year. So the alignment drivers we want are for those things. So let's look deeper at each of them. And when I say bonus targets, usually they're called short-term incentives and long-term incentives. Now, they don't have to be called that, but that's become the standard terminology, is STIs and LTIs. In the end, they're really bonuses. You know, they may describe them in a different way, and they may talk about them as at-risk payments. They're not at-risk payments. They're bonuses on top of what they're being paid as their salary. And yes, they may not get them. That makes them at risk. But it's not as if the salary is the greater amount and then they're taking something away from them. It's they get a salary and they get things on top of them. But that's just terminology. So if we then look at these in detail, management are going to strive towards consistently high return on equity, where one or when one or both of the STI, usually a yearly bonus, or LTI, usually a monthly multi-year incentive, includes one of the following: either a minimum target for return on equity with low debt, the way we always look at it in Teaminvest, or perhaps a minimum target for return on capital, not quite as good from our point of view, but nearly. I mean, I certainly, you're never going to find perfect REM reports. So if a REM report is heavily targeted to a minimum target of return on capital, I'd give it a tick. I'd say I would have preferred it was a return on equity and low debt, but it means almost exactly the same thing as return on capital, so I'll give it a tick. And if it's capital intensive, I don't mind, I'm quite happy if there's a minimum target for return on invested capital. Because if this company, like Mineral Resources is a perfect example, they are, because of the style of their business, they are constantly deploying large amounts of capital to build something that they get income on for many years thereafter. Hence, we want the management focused on return on invested capital. In fact, it's probably the only really important metric in a company like Mineral Resources, as they say in their REM report, and I totally agree with. Now, for Blackmores, who've also got a target for return on invested capital, I'm a little surprised. It's not a bad metric, but it suggests they intend being capital intensive. Now, they bought the factory, that's capital intensive, but do they intend doing other capital intensive things? If so, then it's not so much a marketing company that it used to be. So if that's the only target for the incentive, I'd be worried. Fortunately, it isn't. The other part of it is earnings per share. So Mineral Resources, it's an absolute no-brainer that it's return on invested capital. But if the REM report or the incentives in the REM report, short-term or long-term, don't aim at either return on equity, return on capital, or return on invested capital, we can't expect the company to have consistently high return on capital. If it does, that's a bonus, but it isn't what the management are trying to achieve. Low debt, similarly, management are going to strive towards consistently low debt if they have targets for low debt and an incentive based on it. So maximum debt to equity level would be our first choice. A maximum gearing level, not too bad. You just need to read in the REM report what they call gearing, because different companies call gearing different things, or a maximum dollar debt level. Any one of those I'd be quite happy with. The first one's the simplest. The third one's pretty simple too. And it's the discussion I had with Ramsey when I met the chair of the Ramsey REM committee. And she said, what did I think ought to be changed about their REM? I said, your debt's going up and up and up and up. What you really need is that your CFO, especially your CFO ideally, I mean CEO ideally as well, but especially your CFO should have either a maximum dollar level for debt or a maximum debt to equity level, because if he doesn't, he's going to keep making the same argument year after year after year that most of our competitors have even higher debt levels with us, so why are you complaining at us? Well, we don't invest in their competitors. And nowadays, pretty much nobody invests in Ramsey either. But the point is, they're not going to start aiming for low debt levels if there's no incentive to the management to aim for low debt levels. After all, debt's an easy way to build up a business if you don't intend being there for that many years longer. The debt will be somebody else's problem one day after you go away. So the third one is, of course, growing earnings per share. Those are the three things we look at in finding a wealth winner. And again, they'll strive towards growing earnings per share if either their short-term bonus or long-term bonus includes a minimum target for EPS growth, say 10% a year EPS growth, or 8%, or 15 or 5, depending on how fast the company's been growing up till now, or sometimes a minimum target for growth in EBIT or EBITDA. Now, we don't like those as much as EPS, but depending on the kind of business, it often makes very good sense, because if it's a business that is, for argument's sake, buying other businesses, sometimes EBIT's a better measure than EPS. EBITDA usually not as good, but there are some circumstances where it could be okay. So as I say, we're not looking for perfection in REM reports. I'd be very happy if I could get any one of these that I've got on the slide, EPS being my first choice, that they get a triple tick for, But if it's EBIT or EBITDA, they still get ticks. And if it's a minimum target for growth in dollars or total comprehensive income, for those of you who perhaps like me are not from an accounting background, nowadays ASIC and the ASX require companies to report in total comprehensive income rather than earnings per share if they are considered a company with multiple subsidiaries. So for instance, TIP has to report total comprehensive income. T&E doesn't, but they don't always report it as, so they're on EPS growth, the one I've got at the top. And SIQ, I think, uses the middle one there, if I remember correctly. Anyway, it doesn't really matter. It's got to be one of those that we're looking for. So in other words, for a summary of alignment, if a REM report isn't driving management towards high ROE or low debt or increasing earnings, ROE or one of its similarities like ROC or ROIC, low debt or low dollar value of debt, low debt to equity, low gearing, or increasing earnings, then it should fail alignment. And why it should fail alignment, as we've already said, and we've been saying for the whole 13, 14 years we've been running Teaminvest, that the biggest predictors of a wealth winner are high return on equity, achieved with little or no debt, and earnings marching steadily upwards faster than inflation over time, and the steadily is measured by Stager. So seeing as we know those are what drive a wealth winner, we can avoid the rest of the fluff in the remuneration report and just target those and say, oh, at least one of those, and preferably a couple of them, but not too many so it gets too complex, those are the things being targeted in the REM report. And if not, it's probably not aligned with what we're looking for a wealth winner. Now, the last one, but funnily enough, the least important one probably, but the one that I have most people contact me the most about. I don't get too many people asking me about quantum or clarity, but boy, I'm sorry, about alignment or clarity, but boy, I get lots of people asking me about quantum. The question we had right at the beginning is, does this seem reasonable to retain quality people without gouging us? And so there are two parts to it: retaining quality people without gouging us as shareholders. And it's subjective. I can't give you an exact number, but once you've read REM reports from half a dozen companies, you should have a good ballpark of quantum for retaining quality people without gouging us, so you should vote. Now, often people say to me, well, doesn't it depend on the size of the company? Yeah, I suppose a little bit, because if it's a really tiny company and the person in charge is getting paid 2 million, that's a big piece of the profits, even if they're doing a great job. On the other hand, if it's a very large company and they're getting paid 2 million, it's a very tiny part of the profits. So there'd be a good excuse to perhaps even give them a little bit more, and it would still be a really tiny part of the profits. Remember, there are two keys to this, and I've got it at the bottom there. If you think they're being massively overpaid, so we're being gouged, that's point one that most members focus on, but it's the lesser of the two evils. Or worse, that they're so underpaid they may quit, then don't vote yes for quantum. By the way, if I can just chuck in a little joke, not usually my style, but you know, those of you who read a fair bit of history will know that in the British Navy, when they ate hardtack, their bread that was as hard as a rock, harder than toast, the bread invariably had weevils in them. So they would tap the bread before eating it to get the weevils out of it. And the standing joke was you were always looking for the bread with the lesser of two weevils. Sorry, I'm just trying to get on to the next slide. Now, having set up that as a sort of set of basics, what's the quickest way to read REM reports? You know, REM reports can be very dreary if you read every word in them, especially since once you read half a dozen, you'll discover that there's pages and pages that are absolutely identical. You read one company's REM report, you read another company's REM report. If you switched headings of the two companies at the top of the page, you wouldn't know that you were reading which one. because they literally cut and paste them. So keep asking yourself two questions. Is the part I'm currently reading relevant to how they're incentivizing management towards consistently high ROE or ROC or ROIC, achieving this with little or no debt or debt to equity or one of the others, or steadily growing earnings per share or EBIT or EBITDA or one of those? Is it relevant to that? If it isn't, next question, is this part helping me vote on clarity or quantum? And again, if you answer that yes, then carry on reading. If you answer that also no, it's not helping me vote on clarity or quantum. It's not telling me anything about what they're getting paid or how they're getting paid or what the incentives are. And it's certainly not telling me how it's incentivizing them to the things I want. Well, if neither of it is a yes, skip it. It's either regulatory fluff or PR fluff. Now, there are two kinds of fluff in REM reports. It doesn't really matter, and you can skip both kinds. There's the regulatory fluff that ASIC, the ASX, and others require them to have. And then there's the PR fluff, which is what Computershare and others supply them, which makes it sound nicer when they're writing about the regulatory fluff. But both of them really don't tell us anything that we really need to know. By the way, it's not that they can easily get out of having it, so it's going to be there. So assessment of REM reports in the simplest sense, we'll get into some more deep stuff on later slides, but in the simplest level is really common sense. Here are the keys. Companies reporting poor performance should have reduced pay for management and board. In other words, if the performance this year is worse than last year, everybody should have earned less this year than last year. Those that don't do that are unlikely to prove wealth winners. And the reason they're unlikely to prove wealth winners is if you get rewarded better for poor performance this year than you got for better performance last year, all incentives are a waste, and effectively you're getting a salary for pitching up no matter how well you're doing. Now, seeing as people at the top of companies get paid very well, they should at least be achieving something to get that pay. Secondly, those that reporting great performance should have increased pay for management and perhaps board. Now, I was at a dinner party before COVID, and somebody, not a member, somebody was whinging to me about how much money some of these executives in charge of companies get paid. And I agreed. But then on the other hand, if this company gave an absolutely fabulous performance for the year, would I begrudge them being paid really well? Hardly, because if they don't get paid really well, they'll leave and they'll go somewhere else. So if the people got paid, let's say the CEO got $1 million last year, and then this year he grew earnings per share by 50%, which is great performance. I mean, 20% we'd be extremely happy about. So he grows it by 50%. Well, we could hardly begrudge him if instead of $1 million this year, he got $2 million, as long as it was structured in a way in which if he didn't grow things fast the following year, he wasn't going to get $2 million next time. So again, those that don't pay for great performance really well aren't going to prove wealth winners either, because they're going to lose their best people. And that's my third point here. Rejoice if they're highly rewarding, superb results. So don't even not begrudge them, actually rejoice. If they get superb results and they pay their people superbly well, but it's structured in a way that they only got the superbly well because they got superb results, it wasn't a big fat salary, rejoice. They're going to keep their best management, and the management are going to be super motivated to do it again next time. And a key down the bottom, I've said, they invest with those that deliver great result, not those who make excuses. And that's a basic key with everything about REM reports. So having gone through that fairly quickly with the basics, you can always listen to them another time, but it's so basic. We're looking for high return on equity, low debt, and increasing earnings per share. Clarity align, that's the alignment, the clarity that we can understand it, and the quantum that it's going to probably keep good people and probably not be gouging us. And as I've said with other things in investing, there are no absolute 100% certainties in anything we do in investing. You can put mathematical numbers to them, but it still doesn't create certainty for the future. So whenever you're looking at something, you're looking at it on a comparative basis. So when I describe a REM report as being good clarity, I don't mean there wasn't a single sentence in it that was not badly written or that was badly worded, but you know what I mean. There wasn't one badly worded sentence in it. What I mean is overall it was pretty clear. And compared to other REM reports I've read where I really had to struggle to figure out what they were getting paid, I didn't have to struggle at all. There was the usual fluff and regulatory crap. But overall, I didn't really have to struggle to figure out what they were being incentivized towards. Now we're going to get into some deeper analysis. It's less important than what we covered before. In fact, what we've covered up till now is probably on an 80-20 rule, the main 80%. Because if you can read a REM report and it seems reasonably clear, and you look at the quantum and you decide that it's not gouging us, and it doesn't seem to be so little that the best people will leave, and it's aligned with either return on equity, earnings per share, or low debt in one of their forms, that's a company we want in our portfolio as a likely wealth winner, assuming it passes conscious investor, of course. It's a company we want in our portfolio. The rest of it that we're going to cover from now on is just a bit of sophistication on that and probably adds the other 20 and the 80 we've already covered. Here's probably the most important one of the whole lot. When should you read REM reports to get the best value? Without a doubt, I've learnt over the years, the best time to read a REM report is immediately after you read the chair's report and the CEO's report, long before you go to anything else. So read the chair report, you've probably read the one-page summary of how they did in the year, so you know if it's been a good year or a bad year, but you'll get into the other detail later. So you read the chair's report, the CEO's report, and the remuneration report. Now, why do we want to read the REM report right then and not where it is in the annual report? In fact, quite frankly, if you don't read the rest of the annual report, you only read those three, you're probably getting most of the value out of reading it. That's in the one-page summary. The chair report, the CEO report, and the REM report should all express the same strategy for the future. They often don't. And when they don't, the REM report is really what the board is telling management to do. It must be, because it's what they're paying management to do. So if the board is telling management to grow earnings, that's what they're going to be paying management to do. If the board is telling management whatever, that's what they're going to be paying them to do. The chairman and CEO reports, they know, are the things most likely to be read by shareholders, and they produced largely as PR to keep shareholders happy. So if you read the chair's report and the CEO's report, and they talk about growing the business and organic growth being really important and focusing on Australia, and then you read the REM report and you discover that there's a long-term incentive or short-term incentive for making acquisitions, well, which do you think is more likely the truthful thing? It's what they're paying the management to do, because if the management reads, as every management would, reads the chair report and writes the CEO report or helps write the CEO report, and it's totally different to what's in the REM report, if they believed that the truth was what it was in the CEO and chair reports and the REM reports untrue, they wouldn't be motivated to achieve the things in the REM report. So the REM report should be saying exactly the same thing strategically as the chair and CEO reports. Now, one of the things I find really interesting among our members is the members who read REM reports, when we're in a smart and we say, what's the strategy of this company? Those who read the REM reports usually can expound the strategy of the company really well. Those who read the chair and CEO reports can do so for about half the companies and not the other half. And the reason I can, I haven't done a proper mathematical calculation, may not be exactly half off. I'm saying approximately half. And the reason for that is about half the chair and CEO reports tie in with the REM report, and about half of them don't. They tell us one thing in the chair and CEO reports and completely different thing in the REM report. And those who've read the REM report understand the real strategy of the business. Those who understand the chair and CEO report but haven't read the REM report understand what they would like their shareholders to think the strategy of the business is, but it may not be in fact the truthful view of the future. So if you want the truthful view of the future, read the three of them together. If they are so different that you're quite horrified, which has happened to me a number of times over the years, by the way, the first time it ever happened to me was with Orica. I read the chair's report, the CEO's report said one thing, read the REM report and was completely different. This is about 10 years ago. And I promptly put a big cross next to it and said, I'm never going to bother looking at that company again. So, because it's basically telling you they're not being honest with the shareholders. Usually it's not that different, but if the motivations in the REM report are quite different to what they say their targets are, or targets not being numbers, but their aims for the company's future in the chair's report and the CEO's report, then it's the REM report that's more likely true, and the chair report and CEO report that's more likely PR. So just reading the chair and CEO report's dangerous because you may not be getting the real flavour of what they're aiming for. The second is fixed versus variable pay. So this is probably not quite as important as the previous one, but very important too. The proportion of pay that's fixed versus variable sets the level of motivation to achieve the incentives. If you've got a company A with low fixed pay and high variable, taking my simple example of $1 million before, if it was, say, for instance, $250,000 fixed and $750,000 variable, that CEO wouldn't be a very big company if that was the case, because they'd get paid more than that, but I was just using simple numbers. That CEO is going to be very, very motivated to make their variable pay, because $250,000 for a CEO of a public company is literally peanuts. There aren't CEOs that get paid that little generally, but if they've got high variable, they're very motivated to achieve. Now, if you took the exact same $1 million and you made it 750,000 fixed and low variable, the motivation is going to be correspondingly weaker. I'm not saying that the person won't strive for the extra $250,000, but they can live off $750,000 a year quite comfortably anyway. So whether they get 750 or $1 million, they probably are not going to beat themselves up during the year trying to get there, or their staff. But if they're getting 250 fixed and 750,000 variable, they'll try very hard. In fact, if they're getting, or similar numbers, if they're getting 400,000 fixed and 1.5 million variable, they're going to try really hard. But if they're getting 1.5 million fixed and 400,000 variable, they probably aren't going to try all that hard for the variable. They'll make all the right noises. They'll come to every board meeting and say how motivated they are. They'll tell the market how motivated they are, but they're really not going to be putting that much effort into it. Now, over the years, what we found is companies with a strong founder mentality usually, not always, usually have lower fixed and higher variable. Those with a corporate mentality, large board, all independent directors, when you go to the AGM, the board takes up the whole width of the room, and even if it's a very wide room, they usually have higher fixed pay and huge complexity of variable pay. And the question you always want to ask yourself, I've got it at the bottom there, oh, no, sorry, I don't, is, on another slide, is why do companies have a lot of complexity? Usually, you have to ask yourself where there's complexity, who makes money out of providing this complexity? If you can't figure out who makes money out of providing the complexity, then it's a bit like being at a poker table and you can't figure out who the patsy is. Because if you can't figure out who the patsy is, it's you. If you can't figure out who's profiting from this complexity, it's a worry. Now, what I mean by profiting from the complexity, any one of us who's on this webinar could, I'm sure, design a simple remuneration report with relatively low fixed pay and a big bonus. There's no great shakes at it. We've probably all done it in previous businesses we run. Low salary, big bonus if you achieve X, Y, and Z. And then it comes to the end of the year, you see if they've achieved X, Y, and Z. And if they have, you give them a big pat on the back, you present them their bonus, preferably in front of a big group of people who will clap their hands, and everybody's very happy. If it's so complex that you and I can't design it, who makes money out of having it? Not the CEO, not the board, perhaps, some group of consultants, Ratchet, and Bingo. So the more complex it is, the more Ratchet and Bingo can sell their services. If it's simple, you don't need Ratchet and Bingo. A founder mentality doesn't look for them. A corporate mentality does. There's an extra reason why a corporate mentality wants high complexity of variable pay. If you're on a board and you don't really understand the business, you're an independent director who got there because we had to have this big diverse board. Nobody wants to take much responsibility. The safest way of not taking responsibility if anything goes wrong is calling consultants to advise. The consultants give you, especially if they're expensive consultants, they give you a big fat document, many pages, quoting all sorts of research, and explain to you why this is the best way to pay your frog that another consultant told you was a prince, just needed to be kissed and would turn into a prince instead of being a toad. And you get all excited and you say, and what's more, my arse is safe. That's corporate mentality. If this CEO doesn't achieve his hurdles and he doesn't get his bonus and he leaves, or it's so complex that our shareholders can't understand it, but in the end we have to get rid of the guy when we realize, or woman, when we realize it's a toad and not a prince, even though we tried to kiss him. Well, it's not our fault. We didn't hire the CEO. We did an extensive process using very expensive consultants to get the CEO, and we didn't design his pay. We got in other consultants to design his or her pay. Founder mentality doesn't think like that. They think like, we want low fixed, high variable. We want the variable simple so that we can understand it. We want the variable simple so that our shareholders can understand it, because I'm a shareholder too. It will be the attitude, I'm a founder. And the third thing is we want it simple enough that the CEO can understand it and achieve it, and everybody knows what it's all about. And we don't need to pay consultants and spend 30 grand or 40 grand on the consultants putting it together. So when anything is complex, always ask who benefits from the complexity. Now, we don't want accounting quantum. Incentives are often in the form of performance rights or options. In fact, that's part of the complexity that Ratchet, and Bingo sell. If it's just a bonus, anybody could work that out. What do you need Ratchet, and Bingo for? Aha, we're going to, Mr. Jones, as the chair of this company, I must explain to you, nobody uses ordinary bonuses nowadays. Everybody uses performance rights or options or incentive shares. There are a whole bunch of names for these things. Now, the beauty of these things are, for accounting purposes, they can usually be valued, and I've deliberately got that in the little quote marks, using an options pricing formula. Now, the beauty of using an options pricing formula is you can choose the inputs that go into the pricing formula, and you can make the shares worth pretty much anything you choose to make them worth. So this can value them much cheaper than it would cost us to buy shares. So you can put out a REM report saying the CEO's got a performance rights or options or incentive shares valued at $500,000. But in actual fact, when you look at how it's calculated, the number of shares it's going to give them at the share price today is not $500,000, it's $1.5 million. Now, my question when I've been at AGMs and they have that is I always stand up and ask the chairman, can I buy shares at exactly the same price on exactly the same conditions? So if the CEO qualifies, I get them also. If the CEO doesn't qualify, I lose my money, same as the CEO does. I've never yet had a board say, yes, I can. The reason they don't say, yes, I can, is they know darn well that for accounting purposes, these performance rights or options are valued in a way in which they, if they have been valued using a formula, they're not always, but if they have been valued using a formula, that's an options pricing formula as opposed to a straight volume-weighted average price formula. So in other words, if I explain that in more depth, I maybe should have had an extra slide. He's going to get $1 million bonus if he achieves X. And the way but we're going to pay it to him in shares. And the way we're going to pay it to him in shares, we're going to take the volume-weighted average price in the 3 days, 7 days, 30 days, whatever it is before the end of the financial year, divide the $1 million by that. That's exactly the same price I could buy the shares. So, because if I went to buy shares at that same time, I could buy them at the same price. That's fine. No objection with that. If it's an options pricing formula, they put in the cost into the REM report of this much devalued shares, which nobody else can buy at that price except the CEO or whoever it is that's getting these options. They're the only people who can get them at this wonderful price. Then they show them in the profit and loss as only costing what they valued them at. But in actual fact, they've cost a hell of a lot more than that. So we want to assess the quantum when we're doing a quantum, and in other words, does it pass for quantum at the real share price today, not at the price they've got in the options pricing formula. Now, if you look at the options pricing formula, often it's as little as a fifth or a seventh or an eighth. The share price currently $10, and this options pricing formula that they've used, Black-Scholes or Binomial or Monte Carlo or whatever, comes up with a price like $1.50. It's absolute highway robbery the way these are often calculated. It's not the quantum of dollars I'm objecting to, it's the way they're trying to pull the wool over the eyes of the person reading it as to its value. The fourth one's total shareholder return. Now, we've talked about this lots. Where does total shareholder return focus the CEO on spending his time? If a company's bonuses are based on TSR, it's a piece of cake for us to phone them and get the CEO to come and talk to a Teaminvest meeting. Absolute piece of cake, because the more the share price goes up, the more the CEO is going to earn. So you ring up Mr. CEO who's being paid on TSR and you say, can he come around to talk to us? Of course, it's only a question of sorting out his diary. There's no hesitance, there's no should I bother. It's entirely a case of can we fit the diary for when we have a meeting. On the other hand, if they're not being paid on total shareholder return, but they're being paid on something else, would they be so keen? So let's look at these next couple. If it's TSR, what does the CEO want his senior executives doing? Also, talking to shareholders. So when the CEO can't come, he says, not a problem. I'll get my CFO to come. I'll get my head of marketing to come. Would you like my whatever to come? They'll always be super happy to send people to come and talk to us if they're on TSR. If they're not on TSR, they may come, but it's harder to get them to come. We have to persuade them that we've got a lot of shareholders. Between our 500 members, there could be a good few hundred of them that have shares in this company. We don't tend to buy tiny amounts of shares. Our members would generally have, a few $100,000 in a company that they like as a potential wealth winner. And then they sort of think, ho-hum, I better come. Now, does TSR assist or hinder the company towards delivering as a wealth winner? Most definitely it hinders, because the management become focused on talking up the share price to groups of shareholders instead of improving the business of the company. Now, you don't build moats or reduce risks by talking up the share price. Sure, you get a little boost towards your bonus at the end of the year, but you certainly don't turn it into a wealth winner. Now, here's the double question. Why do remuneration consultants, there could have been a question that marked there too, and why do the ASA recommend TSR? Well, the remuneration consultants recommend TSR because they can usually provide a comparator group, which makes TSR much more complicated, so they can charge a lot more for their services. So if they use TSR, they can get paid much more as remuneration consultants than if they use something so simple that the company can work it out itself, like earnings per share, or like reducing debt, or like return on equity. Why does the ASA recommend TSR? I'm less sure, but I think it helps the ASA show what they're doing in terms of value for shareholders and who are their members, because they go and talk to all the companies about their remuneration report and always stand up and talk about it at the AGM. So for your couple of $100 a year that you're paying in membership of the ASA, look at all the good we're doing for you. I may be wrong because it's not a big amount of money, but certainly for remuneration consultants it is. So here's where I've got that thing that I said before. When faced with complexity in any field, always ask who benefits from this added complexity. It's not the shareholders, it's the remuneration consultants, maybe the ASA, I'm not sure, but certainly the remuneration consultants. They benefit enormously from adding complexity. Now, as a reminder, and then we'll go into a couple of other things too, it's largely common sense. Reporting poor performance, they should have reduced pay. Reporting great performance, they should have increased pay. And we should rejoice if they're highly rewarding superb results. So that is probably, in a very quick nutshell, going through what I wanted to cover, and I've got a few more slides still, in talking about REM reports. What I wanted to do this evening particularly was to debunk the complexity. You know, people often contact me and they say, how do I judge this against that? You know, when they've got this kind of a measure in their options pricing formula versus that kind of a measure, the simple answer is we'd be happy if they didn't have an options pricing formula at all. What we really want is we want three things. We want the people motivated towards return on equity, motivated towards reducing debt, and motivated towards increasing earnings per share, or one or two of those, if not all three, because all three may be a bit much and too complex, but at least one of those should be what they're aiming for at the moment. The report explaining that part of it, if you leave out the regulatory fluff and the PR fluff, should be really simple, that when you read it, you say, aha, I can understand this. He gets paid $400,000, or let's take a bigger one, bigger company. He gets paid $1 million in basic salary, and he could make another $1.5 million in incentives if he achieves earnings per share greater than 8%. Then the only thing I've got to decide from a clarity point of view is, did I understand that? Well, that's pretty easy. From a quantum point of view, does that sound like a reasonable amount of money for the company that he's running or she's running? And thirdly, is it aligned? Well, maybe the 8% is a bit low. How have they been growing over the last few years? Oh, they've only been growing at 7%. Well, then 8% is quite nice. Oh, they've been growing at 12% a year. Well, gee, why does he get the bonus for 8%? Then it doesn't seem terribly aligned. So really, reading REM reports are largely common sense, made complex by the consultants who provide the information that often goes into the REM report. When you start reading a REM report and there's a Black-Scholes options pricing method, which is measured against a Monte Carlo simulation, and there are 5 different things that their long-term incentive is based on, and then a whole page of things that their short-term incentive is based on, and it's different for everybody. The CFO's got one group of them, and the CEO's got a different group of them, and different management. I mean, those are things that should have been internal company ones and not even bothering shareholders. The more complex it gets, and the more likely it is that it's not going to be a wealth winner. So reading a REM report and deciding if it's likely to be a wealth winner should, providing you scrap the regulatory fluff and the PR fluff, should be quite easy.